All right. Good morning, everybody. Just give me a second to get everything up and running. Okay. Save. All right. Everything's pretty much up. So today we're doing something a little bit different. Well, first off, welcome to Live Valuation. I'm Midas Moriarty. Today we're going to not do a normal valuation. We're kind of doing the culmination of, well, multiple other streams that we've already kind of covered. So far we have well, I did one stream of at&t I don't know, a month or two ago after the most recent quarter of earnings, and then we followed it up after the news broke about their the merger plan, or the split off merger plan, split off of Warner Bros from at&t, and then the merger with Discovery. So then we did an updated at&t valuation, which I've got right here. This is what we decided it looked like, taking the split off into account, which we found that it actually upped their 5-year CAGR by 1 to 1.5% or so, a little over 1%. Wasn't crazy returns for the next 5 years by my estimation prior to that, but it turned out to be even better returns by doing so, which we pointed out that's because of the low sales to capital ratio that at&t has, as well as the really high debt to equity ratio that they had prior to that. And so by cutting a lot of that debt, and by focusing on a more efficient part of their business, they would be able to actually improve their value, regardless of the fact that they were lowering their revenues significantly. Didn't increase it by a crazy amount, like we said, only by about 1% or so per year for the next 5 years, but it did improve their value by our estimate, because most people were kind of negative on the news, partially because of the fact that they were going to be cutting their dividend very significant amount, by like 50 to 60% probably. They haven't really announced exactly what it's going to be, but based off of the information they gave us, which we'll get into, it's probably going to be like 40% of its current level or so. So maybe like 3% or something like that. So then after that, we also did a Discovery valuation somewhat recently, which we came up with this. It wasn't the most shiny thing in the world, but even assuming a lot of growth potential for them, but even with that, we still found that they're probably a bit overvalued as of the current price. And this is Discovery not taking the merger into account, for the record. We found that they still had some decent returns to them. Not very impressive returns, slightly less than the market return actually. But you know, it is what it is. So the real question is, what would Discovery look like if they did go through with the merger? And so basically what we're kind of doing is taking a look at both at&t and Discovery and trying to decide if you want to own the new company, which is going to be named Warner Bros Discovery, then which company would you want to buy into at this point? Would you want to buy into at&t and wait for it, or would you want to buy into Discovery and wait for it? Or, you know, obviously you could just wait until the merger goes through and then purchase shares of the new company once it changes over. Who knows what ticker it'll be exactly. But the point is Discovery is going to be the one that actually transforms into Warner Bros. Discovery. at&t shareholders are simply going to be receiving new shares in the new company. We'll get into the specifics of how that all works. I have some uncertainty about some details related to that myself, so I'm definitely not super well informed, especially on like the particulars of this deal. I'm not going to pretend that. We're going to be making a lot of guesses and a lot of estimations in what we're going to do here today. But what we're going to do is we're going to take the Discovery valuation, which I've made a copy of it. I have over here another one that's literally the same. See right here, it says 2504. At the moment, it still says 2504, but it's what we're calling our pro forma Warner Bros. Discovery valuation. So we're gonna transform this spreadsheet into what we think is our best estimation of what it could look like once we combine those two together. Now, there's some issues with trying to do this, especially with the spreadsheet template that I use is definitely not well designed for this type of thing. Frankly, it would be probably much better off to actually just put together an entirely separate spreadsheet template that's specifically designed around doing this. I can sort of explain the problems with this, which I mean technically was somewhat of a problem when I was changing the at&t valuation. I kind of had a little bit of these problems, but it was a little bit less noticeable, so I was able to kind of just ignore it, which is to say that this deal isn't actually expected to go through until mid next year, that is mid 2022, and then therefore you're not going to really have a proper first full year of the new company until 2023, which we'll get into when we look at the press release and the presentation surrounding the deal that they released. There's all the projections that they have on what the new company is likely to do. They're making their projections based off of 2023. So here we are in mid 2021. That's a ways away. And so the problem with that in trying to make the pro forma spreadsheet is that we only have the most recent year. And the way that my spreadsheet works is I make a projection of a CAGR over the next 5 years. And that's pretty much where all my inputs are. Like you can see, like my revenue input, I just make up a revenue CAGR for the next 5 years, and then I look at what those CAGRs are over that time frame. But the problem is it's 100% consistent straight down the line. So I don't have like a spreadsheet where I can make the revenue jump especially high in the first year and then have it kind of trail downward. Because I just like to think about one kind of long-term range number, because I think getting focused on the nitty-gritty of the specifics of 1 year, 2 year, 3 year can often lead investors astray by trying to essentially do too much. But it does mean that I lose out on some of the advantage of using that nuance, because plenty of the time companies do get a lot of their revenue growth up front, and then it all starts to taper off. And so that technically means that if I use the same CAGR that high revenue growth up front and then taper off happens, it would be the same CAGR as a certain level of consistency. But by doing that, it means that you actually have lower revenues in the first year than might otherwise be suggested. That we kind of saw this a little bit in the Alibaba valuation that I just did on Wednesday, which is to say that they also probably are going to get higher revenue growth up front. But in their case, I think it wasn't too bad of an issue, because I think it's pretty safe to assume that they're going to have a pretty consistently high revenue growth. But it is high, and so the fact that it's high means that it's more likely to experience that tapering off effect. But in a merger, you're definitely going to see that, because you're literally going to see a massive revenue growth in a specific year, and then not massive revenue growth in other years, because it's a merger between a mature company and another mature company. So for example, like with this right here, we have 2020 fiscal year numbers, then 2021's right here, and the deal is going to go through in mid 2022. So you're going to start to see, for like the second half of this, you would see a pretty significant jump in revenue, and then in 2023 you would see the rest of that significant jump in revenue, and then these years would probably be relatively relatively mature level numbers, or at least maybe, well, at most in line with the most recent CAGR with Discovery, which you can see right here. Over the last 5 years, they've had a revenue CAGR of about 10 to 11%. So it's not like that's nothing to sneeze at in their case. But for example, like with at&t, their revenue CAGR over the last 5 years up to 2020 has been about 3%, partially because of the decline from last year. But that is what it is, and so you can sort of see the difference between that. And so the fact that, for example, a huge chunk of at&t's business is going to be combining with Discovery means that, you know, the revenue is probably going to be somewhere in between that figure for them moving forward, probably closer to the at&t number, because even though this is a merger between Warner Media and at&t, Warner Media is definitely the bigger chunk in this. Discovery is going to be the one that's running it, but at&t is the bigger chunk, which we'll kind of cover that in other details. So the point is that this spreadsheet format is not necessarily well tooled to do this type of thing. So take that into account whenever you see what my results are. That's the big grain of salt that you gotta keep in mind. I'm perfectly aware of it. It has its limitations. That's the limitation. So we're going to do our best. But that is what it is. I'm going to reset this. I did have the distribution shifted away from my default for the Discovery one and stuff like that. And then there's a variety of other kind of assumptions that we're going to have to make that we're just going to have to do our best, essentially. Like I said, that there's a lot of uncertainty that I'm unsure of how to play out into what we're doing, because frankly they haven't given us enough detail of how that's going to work, which is, for example, the exact transfer of debt and cash and securities, as well as the equity transfer and things like that. So like I said, we're gonna do our best to sort of make those estimations, as well as how we change the equity risk premium is going to be a little uncertain, but like I said, we're going to do our best. So let's see. Hold on just a second. I'm gonna start playing their little presentation thingy so I can get the audio kind of halfway okay. Oh yeah.
Is the very best iconic IP in the world. Big brands that really matter to people. And the ability with CNN to lean into that. Not only are we going to keep it, but as I said, we just did GB News in the last 90 days. We were already on a mission. Our mission was news, sports, entertainment, nonfiction. That was our mission across Europe. Now our mission is lean into news, take everything that we have already, and it's substantial in Europe, put it together with CNN, and be the world leader in news.
Okay, I'd like to thank all of you for joining us this morning. I appreciate it. I think from my point of view, you only need to listen to David and his view of where this is going to understand. This is a wonderful opportunity
will work out overall in balance.
Shareholder to move forward in combination with Discovery to build a premier media asset, and I couldn't be more delighted. I think we've set this up in a way where David and his leadership and how he settles this company in has an opportunity to create something incredibly special, carrying the at&t shareholder along for the ride.
This is the press release that they put out on the company. I've gone already through it like a million times, and I was going through it when I was making the changes to my at&t valuation. Let's kind of like go over the details from a little bit of a high level, and then try to break down some of the details into like how that's going to transform the value, which I've kind of already wrote a bunch of notes here. I was looking at it a bunch yesterday and kind of playing with the numbers, trying to figure out exactly how to think about it. Okay, so at&t and Discovery today announced definitive agreement, yada yada yada, gonna combine together. Under the terms of the agreement, which is structured as an all-stock reverse Morris trust transaction, at&t would receive $43 billion, subject to adjustment, in a combination of cash, debt securities, and Warner Media's retention of certain debt. So, $43 billion in net debt transference, approximately. Now, if you look at that,
thank you all.
and look at what Discovery has
To learn
at the moment.
more about at&t, subscribe to this channel.
Did they really just do that? Yeah. If you look at what their
As you saw this morning,
what their debt levels are, they have about $17 billion in total debt as of now.
with a solidified position,
They also have about $14-15 billion in net debt. So what that means is we have about $2 billion or so in cash, and then they possibly have some long-term marketable securities, because this line right here is for short-term marketable securities, in which they don't have listed. So it's possible that they have long-term marketable securities somewhere in the other assets. I can't remember specifically. I'd have to go dig up their annual report to decide that. But the point is they have at least $2 billion in cash. So it's and we're not sure whether or not they want to transfer all that cash straight out, or if they're just going to go with debt. It's probably better just to go with debt, because then you would leave liquidity on the table, which you're going to need to operate your business. So whether or not they do that is a good question, but one thing that's for sure is that it's definitely going to be about $43 billion in overall net transference. So if they're going to get $2 billion in cash, then it would actually be about $45 billion, but it would be about net debt of 43. Now, so one thing that we have to change right out for sure is going to be the debt to equity ratio. The thing about that is Discovery already has a pretty high debt to equity ratio of about 108%. And the debt to equity ratio is not net debt. That's just straight debt. However, it is also the market value of debt, which we have at about $17 billion. And you can see that the difference between the book value of the debt and the market value of the debt that we have calculated up here is actually pretty minor for them. Almost no real difference. Even though they have a pretty significant amount of debt, it doesn't actually change that much, probably because of the interest rate and the maturity coming out to be what it is. So,
consistent execution has cemented their foothold in the United States.
$17 billion
positioning them well for continued growth.
Plus about 43, which we're just going to use 43, not the 45, since we don't really know exactly how they're going to play that number out. So we're going to kind of keep that a little bit close. But
it creates one of the most compelling content portfolios in the world, and enables the new combined company to have
43 plus 16.9 comes to 59.9 over 16.9 means that they're essentially 3.5xing their debt, which is pretty ridiculous, especially considering, as we said, they have a debt to equity ratio of 100%. This is, like I said, there's going to be a lot of assumptions that we're going to put into this, and like I said, compared to most valuations I do, this is something that I'm not going to pretend like I have a whole lot of confidence in how we're approaching this, because I could be wrong in a variety of ways, and if people have better ways of thinking about this, I would definitely love your comments. I would more than happy be willing to go over this if somebody gave me something really, really helpful and really constructive to think about in regards to this, because some of the assumptions in here are pretty out there, and I'm not really sure if I'm thinking about it correctly or not. I'm an AT&T shareholder, for the record, so thinking about it from the Discovery perspective, which is what we're doing here today, is not really something that's my problem. So it doesn't actually affect my personal investment. It just, like I said, I'm trying to decide sort of whether or not this is a good deal for Discovery as it is for AT&T. Now, what that means is, obviously, like I said, we're 3.5xing and it's already at 108% of debt to equity ratio, so we can assume that we're going to be jumping to about 350% debt to equity. Now, that's equity at the current level, and that's something that has to be kept in mind, is that by the end of this valuation, we may be showing that the equity is actually going to be significantly higher. And the fact is you know, the equity hasn't really jumped since the deal was announced. In fact, I'd say it's probably trailed downward a little bit, if I'm not mistaken. So the fact that it hasn't done anything of that nature is kind of interesting to me. But maybe there's a good reason for it.
And of course, my friend Jeff,
so
who I work with, and
on the low end,
we go back decades together.
Oh, and I suppose we'll keep reading before we get into the numbers, because there's other things that have to be taken into account before we make that number.
They have had as they have
So anyway, where were we?
Business for the future.
AT&T Warner Bros restoration of certain debt. AT&T shareholders would receive stock representing 71% of the new company. Discovery shareholders would own 29% of the new company. Board of directors of both AT&T and Discovery have approved the transaction. Okay, now this is one of the other really, really big assumptions that I'm not very sure if I'm thinking about this correctly, but I'm just gonna have to do what I can do based off of what I think I understand. So if AT&T is going to have 71% of the new company versus Discovery's 29%, then that would suggest to me, since you're going to have to issue new shares in order to do that, outside of the possibility of Discovery shares doing a transfer, but I'm not really 100% sure if that's even a feasible opportunity for them to think about. But then that was just to me that you would have to multiply the share count by about 2.45%. There's about 514 million shares of Discovery after you dilute the inclusion of restricted stock units. So that would be, you would have to multiply it up approximately that high. Now, obviously, if we multiplied the share count by that right now, based off of all the other factors included here, then the price per share would drop rather significantly. And so, like I said, the fact that the Discovery hasn't jumped up in price, nor has it gone down in price dramatically, makes me wonder if I'm thinking about this correctly or not, as well as, well, maybe it's possible that they're not doing it because of the fact that the deal's so far out. It's still about a year to a year and a half away, depending on when they actually decide to close it, and
to invest even more in content.
And there's still also the fact that the Discovery shareholders have to actually have to approve the deal. It said in the press release that the boards of both companies have approved the deal, but the shareholders of Discovery do have to actually make an approval of it. I can't remember where it says in here exactly, but AT&T's shareholders are not required to make this deal because it's just an internal unit selling.
The transaction we are announcing
and the receiving of the dividends effectively is like, receiving of the new shares is effectively like a dividend, though it's untaxed. So far what we understand is that we're going to have to multiply the debt to equity by 3.5x, except there's a few other things that have to be taken into account with that, so that's not entirely the whole story there, as well as we would have to multiply the share count by about 2.45x, which that would have a pretty dramatic effect on what the value is at this point, beyond without doing any other changes, but obviously we have a lot more changes to come.
in key areas from the
So,
biggest tentpole films.
Going further back down, okay, they talk about content a little bit and expansion, yada yada. Forming a new company that will have significant scale and investment resources with projected 2023 revenues, here's what I was talking about, of approximately 52 billion, adjusted EBITDA of approximately 14 billion, and an industry-leading free cash flow conversion rate of approximately 60%, creating at least $3 billion in expected cost synergies annually for the new company to increase its investment in content and digital innovation and to scale its global D2C business. Now, okay, like I said, I have some notes here. I was kind of already running through their other information here. Right off the bat, you can see that Discovery has $10.6 billion in 2020. Okay, so let me make sure I'm looking at this all correctly.
This transaction will also
10.6
linear business with more programming and creative opportunities and a sturdy global marketing platform.
Now, if you go dive into AT&T's annual report, let me try and quickly find it, though it's a big document, so be patient with me.
Turner's recent strategic pivot to lock up long-term live sports on TNT and TBS, Major League Baseball, NHL hockey, NBA basketball, and March Madness is a huge plus.
So Discovery has 10.6 billion. This is 2019. There's 2020. 30.4 billion is the revenue that Warner Media had in 2020. So, and there's going to be changeover of the eliminations, so you could say that it's actually 31.4 billion because those eliminations has a lot to do with the transfer of revenues between the segments. So 31.4 billion, 10.6 billion. The 2020 combined revenue is about 42 billion, depending on how you count it. So 42 billion, and they're suggesting that they can get it to 52 billion. Now, the thing about that has to be taken into account is that the revenues of both companies are likely to change over the next year and a half. So it's kind of hard to be sure about that exactly. Like, for example, right here, you can see that in 2019, Warner Media had 35.2 billion, though it technically had a positive number on the elimination front. So that would be maybe 35.2 billion or 34.2 billion versus the, like I said, 31.4 billion here. So it's very possible that that 3 billion of that comes from Warner Media bouncing back, perhaps expanding a little bit further, as well as the fact that Discovery itself may also expand a little bit further. They had a little bit of a drag on their revenues from 2019. They were a little bit higher than where they were in 2018, but they've been kind of expanding since then, though it was partially through acquisition. So the fact that they're projecting, like I said, about 52 billion for 2023 is possibly accurate, possibly a little bit bullish on their front. It's hard to say. This year, this fiscal forward T+3 is our 2023 number essentially, and so this is kind of where we're trying to make it fall in line with that.
To the first high definition channel.
So when we do the revenue cogger, we're going to have to do a revenue cogger that takes that into account. Now, for the 52 billion number, I'm probably not going to make it exactly the midpoint. I might probably try to make it more like this, because I feel like they are including expansion that may or may not be in there. When they try to sell these deals, they do try to be overly bullish typically. So we're probably going to try to make this number right here kind of come out to that 52 billion, which, as you can see, based off the fact that this cogger is really low, we're going to have to essentially put in a really, really large revenue cogger. And so that's what I mean by it being a little bit strange, because the cogger is going to start to build in immediately, and we have to take that into account, that the fact that they're technically not going to be getting those revenues, and so that's going to overstate their free cash flow to equity in the first 2 years. But then it's also going to be under, or it's going to be, yeah, it's also going to be overstated in this part over here. So we're essentially going to have to kind of try and find a happy medium of where we think that this number comes out to where the 52 billion plus or minus would actually be after 2 more years of potential growth after that, which means we sort of have to make an assumption about what we think the revenue CAGR would be post the deal. For example, like I said, they have about 11% CAGR right here, and like I said, if you look at AT&T, they have about 3% CAGR right here. That's overall. If we took like a longer standing Warner Media CAGR, I'm not exactly sure what it would be because I didn't really go looking through the segments for several years in that front. They only have 2018, 2019, 2020 right here in this, which I'm not sure that's really going to be enough for us to really think about. As you can see, they didn't really move a whole lot during that period. Slightly up on that front. I guess it's not too bad of a figure, but
we will now take our first question from Joe Flint at the Wall Street.
The point is I'm not entirely sure how to separate out the AT&T CAGR from the Warner Media CAGR. So I'm just going to go ahead and use the AT&T CAGR as what I think the Warner Media CAGR is, and then you have to take into account the fact that their revenues are already way higher than Discovery. They're about 3 times higher. So if you weight
so I'm just gonna say what is up with
0.3
do you know if he's going to stick around
by 3 and then you add
your management team versus
11 and then divide by 4, you can see that the weighted CAGR maybe would be about 5% per year. So that's what we're sort of going to maybe use, is what we think the CAGR should be from this point forward. And then, like I said, the 52 billion we're going to assume is on the bullish side of things. So if you take 52 and multiply it by 0.05,
personnel and how things are structured moving forward during the transition period, and as he works his way through it, I'm sure he'll be talking with folks about where that's going.
Twice over.
And now, Brian Steinberg.
Then we would say that perhaps in the 5-year forward figure, on a somewhat bullish basis, we could expect maybe about $57.3 billion. So essentially, this number, we want to end up at about $57.3 billion. That's sort of, I guess you could say, changeover 1 that we're going to be making. And then, like I said, that's a very huge change in revenues. I'm not even sure. Let's see what it comes up to. What you have to make happen to do that. Yeah.
You know, first, until the deal closes, we're going to fight.
Again, don't pay much attention to this until we get to the end, because there's a lot of things to take into account here. 57.
Warner Media, an extraordinary company, and then when we do come together.
And then by changing this, it's going to shift all those things around, because this is sort of a bottom figure.
CNN is number 1. The focus will be on talking to everybody at Discovery and everybody.
I'm not really sure exactly what basis I want to think about the bottom is. Might be on the low end. You could assume that maybe they actually don't quite make it to 52 billion, not only in this year, but maybe it takes them 5 years to reach that. So maybe we could say that we want this to be 52 billion, but that could possibly be an overstatement. Maybe we could put that down to like 50 billion. Hard to say exactly what would be the best for the low end.
Can you guys hear me?
We can, Drew.
Okay. Just curious how this all came together all those months ago. Who approached whom when you guys were having these discussions, and
My bad.
was the board vote from both respective companies on this unanimous?
That could be all right.
John and I have been good friends for a long time.
Let's see how this then pushed up the number further than we wanted it to be over here. So
neither one of us
Thought you were gonna say
sell, eating too. But we were supposed to be together at the AT&T, and because of COVID, we were both at home, and so I was sitting around on a Saturday or Sunday afternoon, and just texted John, and we ended up in a 2-hour conversation about the future.
that could be all right, maybe. I don't know.
We talked about
That we're definitely kind of making some shots in the dark as far as how to put these numbers in and think about it.
Yeah, Drew, to answer your question, I cannot speak for the AT&T board. It was unanimous approval. And
then for the analyst number, we'll just throw it in the middle.
Comments as the capital allocator in chief. I've been, contemplating what the right.
Because the analysts definitely don't have any particular kind of projection of the type of thing we're doing, so we're definitely going to have to just kind of ignore that particular model in their case. So this could be a good way of thinking about it, but then if you look at, for example, like I was saying before, the 2023 number, it suddenly doesn't really make it, it's now no longer in line here. So it's understated in this year and possibly this year, but then it's probably overstated in these years. And so whether or not one thinks about that as okay is up to other figures. I'm perhaps willing to actually boost it a little bit, just because I do think it's understated on this end. But the fact is like I said, it's being overstated over here. So this is what I mean by the limitations of this model, is that because the fact that we're just using one consistent cogger across it, it doesn't actually take into account the fact that the deal doesn't happen until here. So what one might have done is, because I thought about this as well, I was like, well, what if I pushed the financial numbers back and then just kind of slapped in my own number there? But then the problem with doing that is if I just decided to try and start with 2023 or 2022, whichever one, and then move forward for 5 years forward from there, is that then I would have to also have an extra part of the spreadsheet built in to be able to discount that year back to the present. And that's just more complicated. And frankly, I think I'm okay with just kind of making some odd assumptions with this. So again, ignore this. This isn't in any way reflective of reality because we have too many other changes to take into account. I'm not really sure. Like I said, it's very possible that we're not going to be able to really think about this in any sort of rational way. It may not actually work out all that well because, like I said, we also have to make the changes to the equity, but the fact that we're also making huge changes to the debt, I think, has a huge effect on this too. So it may not really matter, but we'll see what happens.
What is the structure?
Now,
what's the attack that creates?
Like I said, that was the revenue expectations of 52 billion, which were technically not reaching in 2023. Those numbers don't even really reach until this figure in large areas. Maybe push it up a little bit further. I don't know. It's hard to say.
Does CNN fit in this entertainment company? And do you intend to hold CNN or spin it off?
We love CNN. In fact,
it reaches the 52 billion in these cases, but it literally never even reaches it in any of the other lower years. But it does go significantly higher as in these areas over here.
Directional for us, and our plan was to roll across Europe because we think.
So the real question is, like, how much is it truly overstating it? If you assume that maybe it's like 11 billion here,
and it's hard to match news and sports
across this board, then you could say that there's maybe about 3 billion, 4 billion, so 7, another 4 billion, 11, another 4 billion, 15, 3 billion, 18, 21. So you could say about 21 billion was being overstated in the first year, and then maybe that would go to 12 billion. So then another 8 would be 29. Another 8 after that would be 37. Another 9 after that would be 46. Then another 9 after that would be 55. So just trying to estimate sort of how much revenue are we overstating, perhaps. It's hard to say because, like I said, we're kind of making a bunch of assumptions here. So you can say maybe about $50 billion of revenue is being overstated in these first 2 years, but then it's perhaps being understated in these years. And so the real thing is that I'm trying to do here is sort of make it at least sort of balance out in a sense, if that makes sense. It's really hard to make that estimation, but you can kind of think about it like that. It's like, as long as you think that the overstated revenues in these 2 years is being balanced out by the understated revenues in these years, then it probably is okay. Because again, like, these numbers right here should pretty much all be higher than 40 billion. And these numbers all right here should probably all be higher than 40 billion, possibly 45 billion. And then like I said, these numbers right here are the only ones that we're sort of happy with, relatively speaking, except for these two. I think are probably overstated a bit, but they're overstated because we're trying to make the numbers balance out better. So on net, that's the real thing you have to take into account. You could say it's like on these ones, on these years right here, that'd be 6 times 2, so that's 12. 12 on top of, say, maybe about 11, we'll say 0.5 to give it a little bit of a boost for growth. So there should be about 138 billion there, when in total we have about 216. So that you could say that's one way of doing it, about 78 billion. And then if this is supposed to be about 52 billion or so, then 52 billion times 12 would be theoretically about 624 billion, but this is actually 427. So
this business is really, in terms of attraction, about the big blockbusters.
You can kind of see this is 78 billion overstated here, but then possibly 197 understated there. So based off of that, you could suggest that we actually don't have it high enough at all. Maybe it should be up to 45. That's hard. Let's see. So that would be 433. Maybe a little bit higher. 47. 441. It's still hard to say, but like I said, I would rather understate than overstate in a large way. So I think I'm probably okay with that.
Ed Lee from the New York Times, please unmute your line.
Because part of the reason why is because by getting the revenues up front, that gives you a whole bunch of extra cash flow in the forward area, and that cash flow can't be taken away. So
there's some cost synergies.
I'm okay with understating these years more than I am with overstating these. So the fact that we have understated set up larger over here than over here is fine. And like I said, these are also probably overstated to a degree as well.
So we'll start with a little over $55 billion debt. But this company is going to be a free cash flow machine. When we look out to 2023, we'll have $52 billion in revenue.
I think that's about as good of a revenue projection as we can make in there. Like I said, it's kind of tricky to make this assumption with the spreadsheet I'm using. We're just kind of doing the best we can. So let's keep going. Now, like I said, after the revenue of approximately 52 billion, it says adjusted EBITDA of approximately 14 billion. Now that's another assumption that sort of has to be taken into account.
Over $15 billion in direct-to-consumer.
If we look,
over $8 billion in free cash flow.
Oh, I guess we can just look here.
That leverage, our leverage, come down very, very quickly, and we think that we have some upside on that with $14 billion of EBIT. And so there is a lot of synergy. We think over $3 billion in synergy.
We have about 1,200 in net income.
The left side of this company,
and 373 in taxes back. Add back net interest expense of 648.
We over-delivered, and we ended up with,
and then depreciation amortization of about 1,300.
With a real mixture, almost, you know, it's like half and half.
So they had EBITDA of about 3,600 for Discovery.
We think there'll be great synergy in finding the best and the brightest people, but the objective is attack that business with productivity and talent, great people and hard work, but then spend more money on content. We're going to be starting with $20 billion, and we want to invest.
Now we're going to use the
great content, great talent,
2019 number for at&t because of the fact that they had pretty crazy year for them last year. So we're going to actually sort of ignore that number for them, but which is a little bit mixed and matching because using 2020 and 2019. But 2019 was probably an overstated year slightly, and Discovery's is probably understated slightly. So we're going to just sort of assume that balances off. Like I said, we're just sort of kind of coming up with a rough number for 2019, 2020.
That's what we spend now on content.
Their net income in
And it's a very efficient model.
Add back their
I think about
taxes.
60%. You see, we got 14 billion in EBIT in 23, and we're expecting more than 8 billion in free cash.
Add back their net interest expense.
And we have a team of drivers that are going to drive that.
Right.
And add back their depreciation.
David mentioned that you guys were talking in secret several months ago in his Greenwich Village brownstone. Can you give us a little color? How did it start?
Wait.
You know, I mean, you guys closed on the deal just 3 years ago, and I guess a few months ago you were thinking about, well, maybe this
Hold on a
is
second.
offloaded. Can you give us some thinking about your thinking around that at that moment, and how you guys first started really talking about
Okay,
it?
yeah, that's actually throwing that off a little bit.
Saying secret, I thought we were discreet is maybe how I would describe it. Secret sounds like we're in a bat cave or something.
Oh, my bad. I'm using AT&T. I forgot about that. We'll go just straight in here. That's what I was doing yesterday. I kind of forgot. 'Cause it has it right here, so there's no need to
the employee body who
do that. But if we just take the discovery number and we add in EBITDA.
those opportunities.
Hold on just 1 second.
And as you heard me discuss early on, whether it's continuing to build world-class wireless networks, driving more fiber infrastructure.
My bad. I don't know why I was trying to add in all of AT&T there, but we can just go straight to theirs. If you put in the Warner Media EBITDA, which they're happy enough to calculate for us, and that's 8.8 billion or so. So then the combined number for 2020, because this is for 2020, not for 2019, then that would end up to be about 12.4 billion in EBITDA. Now, like they said in their press release, they're expecting to possibly get to 14 billion, and that would be in 2023. So
and it's been successful, and it became clear to me
12.4 billion to 14 billion over the course of 1.5 year or so. That's pretty reasonable. Now, the thing about this is that we have to sort of try and convert this into a net income number, so to speak, because that's what we're going to use as an adjusted net income, which for them is roughly close to a normal net income, because they're not actually going to have R&D expenses, which is the major adjustment that we make. Now, on here it shows that for Warner Media, the depreciation and amortization was 670, which is not a very significant amount compared to, for example, the depreciation and amortization that they have on their other segments, communications and Latin America. So apparently Warner Media doesn't really have much. It's probably just some content amortization. So if we subtract out that, as well as
on a standalone basis with great assets, and bring it together with,
as well as we subtract out the depreciation and amortization that they have here,
improving our domestic connectivity business. Not that it doesn't help it, but through partnership, David and I intend to continue to work together to make sure that HBO Max is part of the AT&T portfolio.
Then what we have to subtract out is the interest expense, which we'll get to that in a moment, because well, frankly, we have to make the adjustments for the change to their debt, which is going to be a little bit more complicated. But we'll get to that in a moment. I just sort of want to get started on that piece right there. And then, as it says in the press release, $3 billion in expected cost synergies per year, which we will try to take that into account when we move forward with the net income, because we're going to be trying to come up with sort of a net income that's in line over here. But then we're going to try to take into account the fact that theoretically they expect to be able to save $3 billion on probably the better end of things for each year for the 2 years following that. And then on the low end, we'll sort of assume that those synergies don't show up, essentially. So this is how we're going to think about trying to come up with the net income margin that we're going to use. It's definitely going to be a little bit tricky to figure out, but that's what we're going to do. And then as far as we'll have to also make an assumption about tax rate. For the last 3 years, the average tax rate for Discovery has been about 24%, while for AT&T it has been about 16.5 over a 9-year period, which we're using 9-year period because they had a little bit of a chaotic tax cycle over the last couple of years.
And as we were talking,
So
I think of
I'm
this
just
as,
using a larger average for
John
them.
and I spend the next couple of years building these companies.
What was the 5-year?
I see this as the #1 media company in the
Yeah,
world.
so you can see it's like if you
#1 telecom
use any
communications
kind of like random
That's
average
what-
any specific point, it's
that's
a little bit
what our
difficult.
vision is, that's what we think can happen out of this. And I just have
And
to
the fact that
really, as I look at what John has done,
yeah,
because
it's
years
just a
ago,
little bit
I
strange
remember
and hard to
going in
use. So I've kind of been throwing in the
many years ago, before
longer
John was
range
gone,
average
and looking
for
at
that
HBO,
tax rate in
the idea that
particular.
this idea of
So let's
us
keep
coming together with
going.
HBO is something that for years I've thought
For AT&T
makes
and
a
its
lot of
shareholders,
sense.
we can
But
kind
when
of
I went
skip
in
that
there,
part since that part's just about AT&T and their shareholders.
aside from
It's
building
going to be
companies
led
that
by
sell
CEO
great
of
value,
Discovery, David Zaslav, which is
to maximize the
a
value
pretty
out of selling it,
a
sort of like an arm
well
dealer, and that's a very good
a well-tried
strategy.
CEO in the content game. He's got a pretty great record, which is one of the reasons a lot of people are actually pretty excited about this deal. Is the idea that he will probably be able to lead Warner Media better than the previous guy who was in charge of Warner Media, and then he's been focused on this industry entirely, while AT&T has always been a little bit all over the place and not really focused. The new company board was going to consist of 13 members, 7 initially appointed by AT&T, which protects the shareholders' interests because, like I said, about 71% of the companies could belong to AT&T shareholders, including the chairperson of the board. And then Discovery is going to appoint the other 6 members, which will include the CEO, David Zaslav. So obviously, a majority of the shareholder board members comes from the AT&T, but the kind of controlling leader, the CEO, is going to be coming from Discovery. So that kind of balances out the fact that the majority of the interest will belong to AT&T, but Discovery is giving over their entire company in order to achieve this.
3.5 years on a mission to turn this company.
All right, now the transaction deals.
With
Combination will be executed through a reverse Morris trust, under which Warner Media will be spun or split off to AT&T shareholders via dividend or through an exchange offer, or a combination of both, simultaneously combined with Discovery. The transaction is expected to be tax-free to AT&T and AT&T shareholders. In connection with the spin-off or split-off of Warner Media, AT&T will receive $43 billion, subject to adjustment, in combination of cash, debt securities, and Warner Media's retention of certain debt. The new company expects to maintain investment-grade rating. That might be tricky. And utilize the significant cash flow of the combined company to rapidly delever, hopefully, to approximately 3x. That would be debt to EBITDA is the number that they're referring to there, within 24 months, because it should be like 5x or something at the start.
I have one for David and one for John.
Which
David,
we'll look at that in a minute. Warner Media has secured fully committed financing from JP Morgan Chase Bank, yada yada, along with Goldman Sachs, yada yada, to fund the distribution. The transaction is expected to close mid-2022, subject to approval by Discovery shareholders and customary closing conditions and receipt of regulatory approvals. I think the regulatory approvals is probably no problem. The only question I really have is whether or not the Discovery shareholders are actually going to approve this deal or not. In my opinion, like I said, I mean, we've only just gotten started, but we'll have to see what really happens, because I'm not entirely sure exactly whether or not this is actually going to be something that looks good to them or not. The fact that you can look at this multiple ways. The fact that the share price hasn't really reacted much to it, it kind of makes it a little bit tricky for me to see what the shareholders really expect. Because on one hand, the fact that the shareholders didn't react to this might signal that it's a good thing, because obviously we haven't really finished yet, but it's possible that this is destructive to value for Discovery by taking on all that debt. And so maybe they would see it as a negative and the share price would go down as a result of that. But it's also possible that it hasn't reacted because the shareholders themselves don't believe the deal is going to go through. And if that's the case, well, then why would they react, right? So it's possible that that's what's being implanted into the current price today. And then, but maybe not. Maybe that takes into account the fact that it would go down based off the fact that people are concerned about the debt. But then, because people are a little bit bullish on what happens after that, maybe it balances itself out. Or maybe it's because that it's about 1.5 years away that it hasn't reacted yet. It's hard to tell. But usually when a merger or an acquisition is announced, you can usually see what's happening on the charts, so to speak. It's like, but usually, like if it's a simple acquisition, for example, a large company is acquiring a small company, and the deal is announced, usually the company that's being acquired usually jumps significantly on the day that it's announced. But part of the reason that happens is that there's usually a price associated with that, and that price usually is at a premium to whatever the market price is. And so the jump in the stock price will be up to around the price that's been announced for the acquisition, except that it'll probably usually be below that price by a little bit, and that little bit, it represents the percent chance that the deal doesn't go through. And so it's what they call merger arbitrage or acquisition arbitrage. It's not actually arbitrage, because arbitrage requires something to be riskless. But basically the idea is that if you buy shares of a company prior to the merger being announced, or even the day that the merger is announced, then and hold it until the merger is closed, then you could essentially acquire that extra premium that the company is paying over the market price, which is essentially where goodwill comes from. For anybody that's not aware of how goodwill works on a balance sheet, essentially what goodwill is the combined excess premium that's been paid for acquisitions. It's essentially the cost above the value of the assets that you paid. It's how much did you overpay for an acquisition in order to acquire it over book value.
And after thinking about what those options could be,
and so
it's an incredibly powerful combination.
This isn't that type of acquisition or merger. It's as they said, an all stock reverse Morris trust rather than a cash and stock acquisition. So the fact that it's not quite the same dynamic, but either way, if this was a bad deal and people thought it was likely to occur, you would expect Discovery to have dropped when it was announced. Likewise, at&t did go down when it was announced, but it went down when it was announced, I think partially because of income investors being concerned about the loss of the dividend, which it's mostly recovered since then. But either way, that's what happened. So it's possible that the market doesn't actually think this deal is going to go through at all, but we'll have to see what happens as far as that goes.
Good morning, and thanks for taking
Now, the rest of this press release is, like I said, about what happens with at&t after the fact, as well as other deals related to the grouping of that.
Just so I understand it,
there's some other deals to look at in their large presentation that deck that they came up with here.
And two, David, you mentioned
as you can see, this is sort of what I was talking about. It's like the resulting structure. at&t shareholders are
check on the question, is CNN
100. We're going to own 100% of at&t still, except for Warner Media. Warner Media is going to be transferred to the new company, as well as $43 billion of debt is going to be transferred, or $43 billion of worth. That includes mostly debt, but possibly some cash as well, is going to be transferred. So essentially, at&t, which has a huge amount of debt, is going to be losing debt on a net debt basis of about 43, as well as they're going to be losing all of the assets related to Warner Media. And then they're also going to be acquiring 71% of the shares of the new company, and then Discovery shareholders are going to retain all of their current shares, which is going to then at that point make up 29% of the shares of the new company. And then they're also going to have 100% of Discovery's debt, which is about $15 billion, as they had it right here. The difference that they have versus what I list as, like I said, it's about $17 billion, is because I'm also including capital leases as debt. That's something I always do, is include operating and financing leases, whether or not the company lists them as part of their debt or not. So they're talking about $15 billion of securitized and bank-related debt.
Makes sense is only the best stuff matters. And what
so that's the structure.
HBO and Warner Brothers on the TV and motion picture side.
They're very, very excited about the branding of all that. And I mean, it's worth noting, I mean, this is going to create one hell of a library. That part is absolutely no argument. I mean, all of Warner Brothers, DC, the actual Discovery Channel, HBO, TBS, Game of Thrones. I'm a huge fan. I have a I have a poster behind me. Sopranos, Succession, Sex and the City, all of the Looney Tunes stuff, Cartoon Network, TLC, Harry Potter, the DC universe, including the Snyderverse and all that. Hashtag restore the Snyderverse. Who knows? Maybe the new company will. The Matrix, the third age cycle of the Lord of the Rings, NBA contracts, as well as they made further contracts with Eurosport. We discussed that when we did the Discovery standalone evaluation that we did, is that they did manage to lock down contracts for the Olympics in the future. They have the exclusive European distribution rights for the Olympics, so that's a great addition as well, along with CNN and a variety of other things, Food Network. So it's a very impressive package of IP. Definitely, no doubt about that. A lot of these are kind of somewhat in what you can perhaps call legacy, or things that are older and may not have further things to expand, but there is plenty of other things as well. So I mean, it's definitely very impressive. It's no doubt that it's going to be a media giant. It's just a question of whether or not the finances make sense in total. And then obviously, like, there's sort of a lot of people have been talking about this, making all the whispers of it. If you look like in the comments down in this video, they talk about it. There's some people that are talking about it in here, but a lot of people think that this is possibly even just to set up for further acquisitions in the future. People wonder whether or not Disney is just gonna buy this company itself in the future. I mean, I don't know about that, because it is going to be a pretty large company at that point. And Disney, I think, or at least I feel, is sort of already at their limit of what they can acquire. Maybe I'm wrong about that. I am a Disney shareholder, just for the record, so I sort of have, I guess, biases in that regard. But a lot of people will be like, oh yeah, acquire more content. I wouldn't necessarily want them to. Wouldn't be the end of the world if they did, but I don't necessarily think that would be the greatest thing. So okay, so they did their own sort of pro forma numbers as far as 2020 goes, and they came up with things that are a little bit different from what we came up with, but I would say not terribly different, depending on how you look at it. They're saying that the pro forma EBITDA comes out to about 12 billion. I'm pretty sure we had like 11.4 or something like that, if I'm not mistaken, or 12.3 or something like that. But we were saying that there was maybe a give or take of about $1 billion, depending on how you calculated the eliminations. So it sounds like they're roughly in line with what we were expecting. And then, like they said, they're expecting to grow about 14 billion. And then we came up with about $41 billion in combined revenue, which also could have been give or take about 1,000 due to eliminations. And they're saying it would have been about 39. But then they still feel like it's going to be easy for them, or at least they're confident in the ability to expand it to about 52 billion over that time frame. So our estimates are slightly different, but not so different that I'd say it's a huge issue. It's roughly in line with what they're seeing. And then obviously the leveraging, like I said, they expect to be able to deleverage to about 3x within 24 months of the deal closing, which would be sort of by the end of 2025. So we can sort of use the 3x as their target for that. And then 5x is what they're expecting at close. 5x of the EBITDA of about this point right here, because this is not really at close. Close is going to be mid 2022, but they're saying 2023 of 14 billion. So maybe 13.5. I don't know. We say like that. 13.5 on 5x. I'm not. What was that? 26, 52. 27, 54, 67.5, 67.5 billion or so in debt. That's a little bit, I think that's over the amount. That's not exactly what we're saying, because based off of the fact that they have $17 billion in debt plus we're expecting about $43 billion. That would be about $60 billion. So maybe I'm overstating it a little bit, or maybe they're overstating it a little bit at the close. Or possibly the EBITDA that I'm suggesting is a little bit higher than what they're using. Maybe they're using 12.5 or something. So it's a little bit over in that frame, but whatever they're saying about 5x, it was say right here, based on trailing 12-month adjusted EBITDA mid-2022 closing, excluding synergies. See, and that's part of where the trickiness comes in, is because of the $3 billion per year synergies that they're expecting. By the way, when it comes to these types of mergers, be skeptical of the word synergy. That is always the trick. That is always the thing that they use to try to sell people on these deals. Is well, why are you doing this deal? How is combining these two sets of assets going to be better? Synergies. But you know, synergy is a word that has to play itself out actually in the numbers. And if you can't actually make the number play out, then you know that it's hard to be sure. So again, let's keep looking. They're saying it's going to be about 5x of whatever the mid-2022 number is at close, and then it's going to rapidly delever to about 3x, which we're going to have to use about the 24-month figure, because that's approximately 2025. So 3x of what their EBITDA is in that forward period. Which is a little bit tricky for us to figure out, because the EBITDA number itself is after adding back interest, and then the interest comes out of the calculation based off of what amount of debt you have. So it's a little bit tricky to figure out, but we're going to have to do our best on that front. We were saying that they were going to get about 3.5x on the debt level. And that's going to be at close. And they expect to be able to drop that number to about 60% of that. In terms of the multiple of EBITDA in that time frame. We wanted which would be approximately 2.12x of the current debt to equity ratio, not taking into account the changes to EBITDA. So that would be if EBITDA stayed flat from close all the way to 2025, which is unlikely if the synergies are going to be taken into account. So the synergies, about $3 billion per year, would that be about $6 billion in synergies right there. $6 billion compared to the current level would be approximately 1/3. A little bit higher than that, so let's actually just say maybe it's about 0.35. So theoretically, if the synergies are successful, like I said, we're making a whole lot of odd assumptions here today. Definitely could be very, very wrong in a lot of ways. if the synergies are successful, then we would expect their debt level, debt to equity ratio at the same level of equity to be about 1.77x of the current level in sort of their one of their better case scenarios. We'll put 175 here. And now you may see how that suddenly reversed a lot of the issue we were having after we added all the extra revenue in there. Now, the reason why that changed like that is that we went from saying that the equity investor had to do all of that revenue growth to saying that the debt was going to pay for the vast majority of that growth. Now, this is something I've talked about on stream a few times. I've talked about it with some viewers of the show, in both in comments and in actual open discussion. I've talked about this with friends before. This is the thing that has to be understood about capital expenditures. Revenues, there's two types of expenditures according to general accounting. This is just general accounting concepts, as well as like the actual GAAP, general accepted accounting principles, is that there are two forms of major expenditures. There's operating expenditures and capital expenditures. Operating expenditures are about how you keep revenues, right? They're the difference between your revenue and your net income. And then capital expenditures are money that comes out of your net income, or at least out of the cash that's relevant to your net income, in order to fund expansions of your business, which is sort of how you get new revenues. So capital expenditures get you revenues, and operating expenditures are how you keep those revenues. And so essentially, when you have capital expenditures, because net income is your profit, but then what you decide to do with your profit is the question. Now, net income that doesn't get paid out to shareholders gets retained in the book value of the equity, usually in the retained earnings portion of it, though it can be a few other little slight areas of that as well. So either capital expenditures either come out of your retained earnings, or they come out of the issuance of new debt or equity. And then if it comes out of equity, well, then it dilutes the value of the shareholder. If it comes out of debt, it doesn't dilute the value of the shareholder, but then it requires you to pay interest payments as a result, which means it lowers your net income because interest is a part of those operating expenditures. So essentially speaking, to fund the form of your company, you either have to adjust the operating expenditures, or you have to adjust the capital expenditures, or you have to take it out of earnings that have already been made but haven't been paid out to the shareholder. One of those three forms is basically the only way you can expand your business. And so by doing this, what we're showing here is that we're actually going to be taking the vast majority of this out of debt, which is the whole point of issuing the $43 billion. Now, we haven't affected the share count, which, like I said, is essentially the new shares that are going to be issued in this. So it is debt and equity that we're using to fund this massive expansion of their business. They're going from, like we said, about $11 billion in revenue to closer to like $40 to $50 billion in revenue. So they're massively expanding their revenues, and they're using both debt and equity to do so. Now, this is, like I said, on sort of maybe the better end of things, but that's also not taking into account the fact that the market cap might change, because this is a market value of debt to equity, so we have to maybe make some adjustments to that later. But for the assumption that first that the market cap doesn't change, it's going to be maybe about 175% of debt to equity ratio on the better end of things, compared to the 108 here, which we have scaling upward. And in the forward 2023 year, it's about 148 million, which, like I said, is a little bit messy. because what would actually be happening is that this would stay roughly steady, 108, 110 or so, and then here it would actually probably jump to like 200 something, and then it would dwindle back downward to here. So it's possible that we're sort of understating it a little bit to the degree. Maybe we can push it up a little bit further. I don't want to push it up too much further because it's going to be affected by other things we do up here. Now, go back to what we were doing on that front. Back to the presentation. Now, they're saying 3x after 2024. Now, 5x. Oh, but it is also worth noting that when you do these things, it's not that like issuing new debt is just some free reign. Don't get confused by that fact of being like, oh well, then maybe you should never dilute the value of a shareholder. You should just always issue debt. Well, again, you have to pay interest, so it's going to lower your net margins, which we haven't even gotten to yet, as well as it depends on what type of interest rate you can get. It's worth noting that Discovery's interest rate is about 4%, with a weighted average maturity of 14 years, versus at&t has also about a 4% interest rate, and their weighted average maturity is about 17 years. Now, I'm willing to bet, I don't know exactly yet, but I'm willing to bet that at&t is going to shelf off some of their lower average maturities to Discovery in order to do this. They're probably going to get to pick and choose which debt that they send over. And they're probably going to choose what's most beneficial for them, which means it's going to be either high interest rate debt or low maturity debt, maybe a combination of both. So it's worth noting that the interest rate might rise a little bit, and the maturity might come down a little bit, which would have a somewhat negative effect on that as a whole. And then beyond that, adding debt to your company also changes your beta. The type of beta we use is we use an average distribution of betas based off of the industries that they're in, and then we take those industries' average debt levels and cash levels, and then essentially work backwards to come up with what the debt would be for a company in that industry on average if they had no debt, which is what we call an unlevered beta, which for Discovery that comes out to be 0.9 for them. And then we use their debt to equity ratio and their tax rate and their interest rate to essentially re-lever up that beta to specifically what a company with that industry beta would be with specifically that debt level. So for Discovery, that means they go from a 0.9 unlevered weighted beta to 1.64 levered beta. So that's what we start with on our base year, and then based off of what debt to equity ratio we choose for the 5-year forward period for them, we actually have the beta move upward over time towards that. So it's not a free lunch. That's something that has to be understood, is that if you affect the debt to equity ratio for a company, it can be less capital expenditures for the shareholder, but it means more interest payments for the shareholder, and it also means more risk for the shareholder. And that makes perfect sense if you just think about it intuitively. So that's worth noting that by doing this, they're significantly increasing their beta. And by significantly increasing their beta, that means that they're going to be significantly increasing the cost of equity. Cost of equity on the base we have as 10.14. And then, for example, in this 180% scenario, their cost of equity actually comes up to 11.23. So it's no free lunch, or my bad, that's the risk premium, 12.73. So it's not a free lunch. It's just a lunch that you don't have to pay for until later, because that's the difference between debt and equity, is that debt, you have to pay the interest every 6 months. It's contractually obligated, and if you fail to do so, you can go into bankruptcy. But a cost of equity is something that doesn't have to actually be paid until, frankly, never, depending on how patient your shareholders are. It just means you have to be liable to the shareholders that you're going to have. And it's worth noting that Discovery doesn't pay a dividend. That's usually the cash way of for having to pay your shareholders, or buybacks, but buybacks can be put off until much later, as can any other form of anything. So it's either you have to pay them with dividends or buybacks or by further expansion of your business. So as long as you can make a good argument to your board of shareholders and to the shareholders meeting, then and to the analysts during the calls, well, then you can kind of push off this cost for much longer. But this cost has to be paid no matter what. And so essentially that's sort of the trade-off between those two things. So as we said before, they're massively increasing their debt to equity ratio, but they're also going to massively be increasing their share count. So the mix between the two is really the true costs of it, which is what we often refer to as the weighted average cost of capital. And we're not really going to be able to figure out the weighted average cost of capital that much for the pro forma form of the business. This is what it is pre the merger, and this is the cost of equity pre the merger. So anyway, back to trying to make this estimation. Now, as we said, they're sort of assuming that they're going to go down to 0.6 based off of that, and we could say that maybe that's a bold assumption. Let's just say maybe instead it stays at sort of the same level, which would be 3.54 of the 108. So it could be 383%. Let's maybe say about 400%. Now, again, that looks very exciting because it massively increases the share value. But again, we haven't affected the share count yet, and so that's something to keep in mind. Is that's pre us adjusting the share count, partially because I didn't want to make the number look super negative right up front, but while people were being like confused as to why the Discovery hasn't crashed to the floor. And this is why. It's because by issuing the massive amount of debt, but also issuing a massive amount of shares, they're probably going to balance each other out in some sort of way. And then again, so our worst case scenario assumes that they lever up massively, but that they also fail to delever over the course of the 2 years that follow. And then this assumes that they massively lever up, but do manage to lever down to approximately the level that they suggest that they're going to over the course of the 2 years that follow. We'll leave the analyst number in the middle approximately. And then, like I said, we may be adjusting these numbers for the change in the market cap as well. So let's go ahead and take a look at that share count now. Wish I hadn't exited out of that, but whatever. Now, like we said, at&t is going to have 71% of the company versus the 29% of the Discovery shareholders. So theoretically, they're going to be multiplying their share count by approximately this amount. That doesn't take into account RSUs. I don't think at&t RSUs are going to transfer over, so I think it's safe to assume that we can leave the Discovery RSUs as basically what they are. And the share count in the most recent quarter of Discovery was 505, blah, 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 blah. Let's go ahead and throw that in there. So this is, like I said, probably the part of this that I'm actually the least sure about. I feel like maybe I have no idea what I'm doing here. But considering, like I said, the change to debt to equity changes it so dramatically like that, the fact that we did make this number jump up so huge by doing that makes me feel like maybe I do actually know what I'm doing here. But it's worth noting that this is definitely the kind of the part where I'm like, do you know what you're doing, Derek? But we shall see. Approximately that. Hold on. Other things to change still. Because we still have to change the debt to equity for a variety of other things too. Because as I said before, the debt to equity ratio is based off of market values of debt to equity. So we have to sort of be able to take into account the fact that the equity value is changing in these ratios, which means these ratios are actually too high at the moment. So we need to bring them down. It's just I didn't know where to bring them down to yet, so I sort of have to do these things sort of simultaneously and work with them together. And then there's a variety of other things we have to do too, because like for example, we're also dramatically increasing the interest rates or the interest levels, which is going to dramatically increase the chances of default. So we're going to have a lot of other things to adjust. So again, don't take anything you see too much as sort of like the direction we're headed. There's a lot of things in line here that have to be taken into account kind of all at once in order to create the correct value. We're nowhere near done. Okay, I'm not 100% sure how I want to go about this, but let's assume that the market cap drops by about 50% on the worst case scenario. It's a little bit of a pulled out of the hat kind of number, but we're so in that circumstances, the debt's increasing massively, but the market cap's moving down. So we're going to assume that the worst case scenario number here maybe stays the same, but then this is the number that we're going to have to affect significantly. We're going to assume that if you look on a market cap basis, it sort of assumes that if the share price stayed exactly the same, but the share count increased that level, what that would dramatically do is it would increase the market cap as effectively as we did, and then that would essentially 3x the market cap, which is why it essentially goes from 38 billion to 90, 100, 120 billion, 120 billion or something maybe in the midpoint. So it sort of 3x's the market cap, which means we would sort of have to divide appropriately by that. And then it would double over the time frame because of the changes in the revenue. It's arguable that this should be 90%, possibly 60%, possibly even lower depending on that. But like I said, this depends on a lot of assumptions surrounding the market cap change. Maybe actually 30% because of that. And then we'll have to make further adjustments once we finally can get the margins and the interest rates in, because that's something that we can actually make a little bit of a better projection on based off of the things that they gave us, because the numbers they give us were leverage rates based off of EBITDA to debt, and so that's part of the issue, is that we don't have the ability to calculate EBITDA at this point yet, but we will, and then once we have that, we can make a little bit better adjustments. Yeah, see, this is the thing that we have to change dramatically, because as we said, we're expecting them to have about $58 billion, but in the way that we have because what we do is we use the debt to equity ratio to work backwards towards the debt and the equity values. it's not based immediately off of those forms. So we actually have these kind of like implied debt numbers, and as you can see right here, nothing about this makes any sense. There's no way they're going to have $7.4 trillion in long-term debt in their worst case scenario, right? So it's like in the best case scenario, we would assume perhaps that they came down. This is what I mean. It's like we can use this number to figure out what once we can have an EBITDA number, we can use those to figure out the ratio. But we know that, for example, this percentage that we're using here is way too high because it's getting us $7.4 trillion. So again, like I said, it was sort of a placeholder number. There was no reason for us to hold that number as logical. It was me sort of making an estimate to see where we stood. Now we dropped that by half, $1.6 trillion. Still way too high. See? Because like I said, we didn't know how we were going to change the equity amount yet because we hadn't changed the share count. And so that's the thing. It's like I was sort of just throwing some numbers in here so that we can play with them, but we really have to look at like 3 or 4 or 5 different spots on this spreadsheet to make sure everything remains logical as we go. That's sort of the issue with this, is that you can't take any one change I make and how that affects the share price that's up here as some sort of like logical path of where we're going. We're going to shoot up and down until we find every part of the spreadsheet making sense with each other. That's a part of how my spreadsheet works, is like you put in one set of assumption, it changes several other parts of the spreadsheet, and you sort of have to look at every corner of the spreadsheet in order to make sure that everything is logically consistent with itself. So because I mean, as we said, we're sort of expecting about $58 billion in debt, and then in their case they were suggesting that their debt leverage levels are going to be a certain thing at closing and then a certain thing at 24 months. But we haven't, like I said, been able to adjust or be able to estimate their EBITDA number, but we will slowly be able to figure that out, because part of the thing we're trying to figure out right now is their future interest payments. And so as we get to an interest payment that we can trust, at that point we can make an estimation of what their EBITDA is. And then once we have the EBITDA number, we can readjust the debt level a little bit further. See, so it's like we have to adjust the debt level in order to find the interest payments. Interest payments form the EBITDA, and then the EBITDA to find the debt level. So it's a little bit of a circle that we have to adjust each piece for as we go. So at the moment, we have an implied $27.3 billion on the best case scenario, which 27.3 divided by 3, or would get you 13.65 billion in EBITDA. Now they have an EBITDA assumption of about 14, so it should probably be a little bit higher than that. Because our best case scenario should probably overshoot their EBITDA assumption. $45,869 divided by, well, let's actually use 2.5. So that's actually the lower end of it. That would get us an EBITDA of 18.347. Now again, that's 18.347 in 5-year forward, which is why we're sort of using the 2.5 number. This is the 2023 number that they're using. So again, they're expecting $3 billion in synergies. $3 billion in synergies for 2 years would be 6. That would be actually closer to 20 billion. So let's actually try and aim for that. So 20 billion times 2.5, we can use that. That would make us assume that they should theoretically have about $50 billion in debt in sort of the best case scenario. So let's actually increase it a little bit more. Not too much. It looks like it's okay. I'm fine with that. So we've locked down this number relatively. That's pretty good. Now we have to readjust this because this part's going to be screwy as well. As we said, they're going to be closing with about $58 billion. It's probably unreasonable to assume that over a 2-year period they're going to go from $58 billion, which isn't even here at all, up to $182 billion. That's probably unreasonable to assume. Maybe 50% higher in the worst case scenario. Hard to say. It kind of depends on how you want to think about it. How much debt is the world really going to issue them? If you went 50% higher than that, that would be $87 billion. Oh, we went way too far. Didn't realize it would make that dramatic of a flip, but it did. Now we went too far, slightly. It made a pretty large jump there. All right, there we go. So on the 5-year forward targets, this makes a little bit more sense. Now we do have to adjust the analyst number, but just want to make, like I said, we're just putting the analyst in the middle for what we're doing. That makes it make a bit more sense. And that's going to drop that down pretty significantly. See, look, now that we've actually adjusted our equity and debt ratios a lot more logically, now we're back to sort of like a reality-based number that's not crazy. We still have, like I said, lots of other things to do. We're nowhere near done, but it's starting to coalesce into a picture that makes sense. Our assumptions about market cap are back down to a reality too. Like I said, these are sort of estimations that I'm just using for the debt to equity ratio. It's not actually like a projection of what the actual market cap might be based off of, for example, share pricing. We still have a lot of other things to do for this to fully make sense. Because, like, for example, you can see right here that it makes the worst case scenario of the market cap trail back upward. So that doesn't logically follow. But that's part of the reason that we don't have some other things filled out. That's there for making estimations of other things, not really for the actual outcome. Now we have interest payments that are possibly a lot more in line with reality at this point. We can possibly change the basing a little bit, because like I said, I do think the interest rate's likely to move upward slightly. I'm okay with doing that. Now, we're going to do the EBITDA figure that I was using before. It kind of got it raised. So we take the 8.8 billion in EBITDA that at&t has for Warner Media, and we subtract out the eliminations because those are not going to exist. And then we add back the depreciation and amortization. And then we go back to the 2020 numbers for Discovery, and we add the net income And then we add back the taxes on that. Plus, we add back approximately 4.1% of the $43 billion in debt that AT&T is transferring over to them. And that gets us approximately what their earnings before taxes should have been. And then we're going to use about a 20% tax rate to get us what we would expect the net income to be in 2020. It's a little bit of a rough estimation, but what we come up with is $3.2 billion. It's rough. It's definitely very, very rough. I could be making some estimation errors on there, but compared to the combined 2020 revenue of 41 billion, possibly 42. We'll say 42 because of the eliminations. That gets us 7.6. I feel like I had a different number when I did these yesterday, so I feel like maybe I did this wrong. Hold on a second. Did I forget something before doing the taxes? I might have. So that's lower than I think it ought to have been, but let's try it. Let's try it again. Let's just be hold on. Start with Discovery. 1219 plus 1359 plus 374 plus 648. So this is the EBITDA of Discovery plus 8863 minus 232 because that's the eliminations. So that gets us the EBITDA of the combined two companies. Now we subtract out the depreciation amortization. Oh, the interest payments, that's what we have to subtract out. I think I didn't do that right. That's right, because that's why we were doing what we were doing. This is a little bit rough because we're going to be using the 2-year forward figure, but it's the only way to get closer to the actual interest payments that we would expect. Before, in fact, that's probably understating it a little bit because of the forward number. Because like I said, we're kind of moving. It's a little bit of a rough average, but we're just going to have to go with what we can get. So 2008. And then this times 0.8. Yeah, okay. So that was closer to what I was coming up with before. Was about 15.9. And then we'll compare that also with the 39, was it? 39 billion, yeah. 39 that they have here, which is a higher amount. But the thing is, we're also probably forgetting about some amortization because of the deal. So 15% might really be the actual range. But then what we're gonna do is I'm just going to chip off of this figure right here, or maybe I'll just do it off of this one, but just to be safe. So I'm being generous to them in this form, but then I'm going to chip off 80% just for, frankly, just for estimation error, because we're doing a lot of estimating here. So perhaps about a 13.44% net income margin, sort of middle case there. So I'll give them a little bit of bullshit there. We can deleverage a little bit further. We might actually adjust the estimations a little bit downward. And I actually think that my estimation on the high end of debt was probably a little bit higher than it ought to be. So I did do double, and normally I don't really quite go up to that level. Normally I do more like a 50% increase. So that's probably a little bit more reasonable. And we're still not done, but we're getting closer. We're getting closer. Now their interest coverage ratios are starting to look a lot more more feasible. That's good for them. We haven't gotten to that part yet, but we'll get there. Now we have to do some changes to the risk premium. It's gonna be fun. I'll try and finish this up a little bit quicker. I don't have terribly much more time to do all this. But we got to add Warner Media to their segments. We're going to leave all the other stuff in as it is. Then we need to add segment to it. was it before? 0.9. So we'll be lowering the weighted beta prior to debt equity, which is going to help improve them, because actually it looks like it's going to lower their overall levered beta as a whole, and so that could indeed actually lower the risk profile. But it is going to also transform the expectations for sales of capital that we would have and the margins we would have. $12.27 is what we come up with for that. So our assumptions of about 13.5 in the middle is perhaps not too crazy. We may have come up with a reasonable expectation for that. Sales of capital is high, but it was high before when they also weren't achieving it, which is pretty in line with what we expect for the communications business in a general sense, combined with media, which is what we had for at&t. at&t has the same problem. Discovery is just a pure media company, but still sort of had the same issue. But on its own, now there's also changes to the geographic distribution of their risk, which unfortunately we can't get specifics on for Warner Media alone, but this is what we're going to look at. Discovery has 65%, 66% of the revenues coming from the US, about 34% coming from non-US. They don't give us too much specifics in that regard other than the production area, production being 53% US and others for the rest of it. And for at&t, it's about 90% US. So that's the revenue that we have overall in the segmenting part of it, minus the revenue we have in the risk premium part of it comes to that, and that over 10.671 gives you the ratio between the two. So this ratio times or actually no, what we want to do is we want to just add this part in. Yeah, okay. So this is the tricky part. Okay, now here's the part where we wanted that ratio. Doing the ratio times the 90%. Oh, that's right. We already had that in. We don't need to do it quite that way. What we're going to do is, okay, so on AT&T, it's 90% US and about 10% global. So what we're going to do is we're going to multiply the equity risk premiums that way. 0.9 times 4.72, which is the US base start of the year risk premium. And then that's plus 0.1 times the global. And the global is 5.76. That's going to get us our pro forma Warner section, which is 4.824. And then we're going to add that in to there. So that's going to get us our new revenue-based geographic equity risk premium of 4.89. We're going to go ahead and leave the production part of it alone. It's a little bit trickier to do that, but it comes sort of to be a similar situation, but I'm going to go ahead and just leave it and only do the revenue part of it. And then what we're going to do is we're just going to weight the production versus revenue, which is what I have this figure right here. I normally have it about 50-50 between it, but we're just going to lower the production to 25% so that it weights a little bit closer to the revenue part of it. So that gives us a new updated equity risk premium of 5.12. 5.12 multiplied by the levered beta of 1.09 gets us 5.59, plus the first risk-free rate gets us a cost of equity of 7.09. So that's going to be the discount rate that we are using. Oh, I do need to change this. Now, they're massively increasing their overall capital base, but they're also massively increasing their revenue base. So I want to be a little bit on the conservative side as far as sales and capital goes, because I think it's pretty safe to assume that they're going to have to increase their capital base in general to be able to fund this further. On a distributed basis, we kind of have it a little bit higher. Actually, I probably want to lower the long-term debt a little bit further. On the worst case scenario side, we still have that a little bit higher. After adjusting some other factors, it pushed it up further. So the point is, because we had it lower before, so it kind of pushed itself up. So let's lower that number a little bit further. Too far. Very sensitive on the low end. It's probably a little high. Probably a little high too. Maybe I'll come back to the 7, but then lower this to 18. Yeah, that was a little bit high. Okay. Getting closer to an answer. Okay, still have to adjust this a little bit. 0.2 I'm fine with, but we're probably going to lower the top end to 0.6. By the way, if you're watching and you're enjoying and getting some value out of this content, please subscribe to the channel, like the video, all of that. It would be very, very appreciated. I stream 3 times a week, usually. Probably readjust this a little bit. Yeah, now this has finally come back into reality a little bit. Like I said, everything's all like, so many of these pieces are interdependent upon each other. So it's like you can't just adjust one and then not look at the way it's affecting everything else around it. You kind of have to like move up and down and take it as a whole picture. It's like adjusting one piece affects numbers over here, and then by affecting the numbers over here, you might have to readjust something over there as well, and that might affect some other third thing where you have to go look at that. It's like the debt to equity ratio affects the long-term debt, which affects the interest payments, which affects the margins, which affects the market cap, which affects the revenue rate. See, it's like it's a little bit of a circular thing where you have to like adjust several pieces simultaneously until they all slide into a place that makes sense logically. Which is why you can't really just pay attention to whatever my number is at any given point in the stream and think that that's the direction we're heading or something. It's like you have to take every little piece into account. But I think we're getting close to done. I think it's starting to resolve itself into one solid picture here. Gosh, baby. Investments. Am I forgetting anything? This would be better. Do that, then eight. Makes a bit more sense. Okay. I think that might be about it. This needs to be adjusted too. It does have a little bit of oddities overall in it because of the chance of default that's going to exist on the worst case scenario, and how that actually turns itself into a liquidation sale where there actually is more value opened up. So on the worst case scenario is going to look higher than it ought to, but it's also possible that the high end is being understated, and that's, like I said, that's taking into account the fact that the company might be at risk of default and might be selling off its assets. If it sells off its assets, it's very well could collect premium on those assets from other content companies, which would result in extra shareholder value. So it's like it's a situation where if the company goes into decline in a permanent sense, it's possible that shareholders could actually recover a significant amount of value, which is one of the reasons that the low end estimate is moving up so much. You can see this, for example, if you come down to where I have the book value per share. The book value per share is pretty significant. So the point is as the company gets liquidated, it actually turns itself into a significant amount of value, more so than allowing the company to keep running. So that's just one thing that's kind of throwing this off a little bit, but it is what it is. It's part of the thing. Let's do some default risk adjustment. Is that everything? Okay, I do think that's it. I think that might be what we were thinking. We can push the sales capital up a little bit. Didn't actually push the sales to capital ratio like up at all though. Oh, I have this off. That's why. I'm like, what am I missing here? Why is it? It's not set correctly. That's why. We were forgetting 10% of the probability for them. Okay. All right. I think that's about it. I think that's what we've got. What we come up with. I want to push the. Yeah, because I was having difficulty getting it to make sense here. That's why I pushed that number up, because I thought that it should stay about 40, but it was below. But it was below because I was missing the probability, so that could be part of the issue. How does that affect everything else, though? Doesn't really affect anything else too much. I think we're okay. Okay. All right, so there we go. This is what our Discovery valuation looked like prior to doing the merger. We have about a little under 6% of annual return for the next 5 years, putting them about 17-18% overvalued at the current price based on a present value basis, selling at about 30.48 currently. We were assuming that they would grow the revenues maybe about 4.5%, which would be a bit slower than they have over the last 5 years, but still relatively chugging along. And about a sales capital of 0.43, return on invested capital of 5.66, really high debt to equity ratio of 104% in 5 years, and a profit margin of about 12.15, giving them profit of 1.673 billion over the 13.381 billion that we have right there. And that's not, it wasn't super impressive, but it was possible returns. Like I said, slightly less than the market expected return and lower than the discount rate we have for them, so it's not very good for them on an overall basis. But if we look at our pro forma evaluation of post merger, it really does improve the picture in multiple ways. We end up with obviously a way higher sales ratio, sales level because of the acquisition of the Warner Media assets. The Warner Media revenues are already like 3 times or 4 times the revenues of Discovery, so it's a huge increase. And then we're assuming on a distributed basis that they will keep growing their revenues because they're going to have their gigantic streaming package that they will hopefully be able to expand further. We're assuming that their sales to capital ratio actually comes down a little bit, partially because of the growth in the business as a whole. And we also assume that their debt to equity ratio comes down significantly, but that's partially on the rise of the market value of the equity, not just because their debt came down. In fact, where their debt's going to be up hugely, it's just going to be up huge rather compared to all of the increases in the revenue and the profits and their overall equity value as a whole. It's possible that that's being understated, but actually pumping that number up actually increases their value. So I think that that's pretty much in line with things. As a whole, their overall risk of default comes down a little bit on the total, but partially because they're going to have that much more cash flow. But that could possibly be understated as well. Their profit margin is going to come up a little bit, but not too significantly, but it's still an improvement, which is on the back of those synergies that they're claiming, though I definitely don't think the synergies are going to show up as strongly as they seem to. If they do show up as strongly as they seem to, we would probably get closer to these numbers, which is the numbers we have on their kind of the best case scenarios. Overall, their profit we expect to be about 7.4 billion during that time frame. And with the discount rate that we have, which is significantly lower than the discount rate we had prior, on the back of the change in the geographic risk distribution, as well as the change in the debt to equity ratio on whole. That does, like I said, rely on the market kind of recognizing this accretion of value to a degree. So if the market value stays relatively low and the extra debt comes on, that could increase the discount rate, which would lower the value. So there is a little bit of a reflexivity effect going on in there, where if the market doesn't recognize the value of this merger, well, then that in itself would lower the value of Discovery as a whole. But either way, that puts them at approximately 27% undervalued, because we have our present value of about 38.96 versus their current value of 30.56, and 5-year forward targets unadjusted for distributions to shareholders of anywhere from 44.54 to possibly up to 94.74, and on a distributed basis we get to 54.95 as an expected value. The worst case scenario is higher than the one above it, partially because of liquidation value that we would have assumed would be taking place under that scenario. So that's just something that has to be taken to mind, that value is probably overstated a little bit, but it's okay because it's on distributed basis. I think it makes perfect sense. But either way, that comes up with a distributed expected 5-year return of about 12.45% per year, which compared to the less than 6% that we have on the pre-merger valuation, I would say that this is actually a fantastic merger for Discovery to do. It turns them from a mostly irrelevant content provider into a formidable content provider, and it seems like the debt that they're taking on to do it, while that you would think that would increase risks for them in a significant way, if the cash flow of Warner Media is at least maintained at reasonable current levels and is in fact allowed to expand globally because of the focus on the content business rather than being split between the communications and content business, then that would actually allow them to perhaps even expand that revenue and therefore expand that cash flow. The only real question is just how much synergy they're going to get out of it, which, like I said, we were skeptical on the synergies, and we didn't try to play them up too strongly in this valuation. So I don't think that that's a negative to this number. In fact, it would, if anything, if the synergies show up, it would perhaps increase it to some of these better outcomes. But either way, it's a massive increase to potential value for Discovery to take this merger. And in fact, it looks like it is indeed actually even better to be a Discovery shareholder than to be an AT&T shareholder. I had made the argument with my previous valuations that for AT&T shareholders, that since we had increased the value expectation about 1% or so by doing this deal, previous to what it was, because it was closer to like 9.5 to 10% or whatever prior to making this deal, that therefore by making this deal they were increasing the value of the AT&T shares, and you were getting free shares in the Warner Bros Discovery deal. So as an AT&T shareholder, which I am myself, I would say that I'm actually extremely happy with this outcome, because it means not only do I get to keep my AT&T shares and get an extra 1% per year by getting rid of the content assets that were dragging them down, but by transferring those content assets to a content provider that does have actual expertise in that business, they will probably be able to unlock their own value to a much more higher level. In fact, it looks like keeping those shares would be a great deal. I had argued that if you didn't want to own those shares, you could just sell the Discovery shares if you just wanted to own AT&T and collect the cash for free, because the shares themselves would be free, or you could have kept this company and sold the AT&T business, and then if you were upset with losing those assets and you wanted to own the communications business. But it looks to me like either scenario is a fantastic opportunity for shareholders of AT&T or shareholders of Discovery or shareholders of AT&T that just want to own Discovery after the fact. Basically, all three of those outcomes are accretive to value, it seems to me. One could even hedge their bets again as an AT&T shareholder by buying into Discovery at this point. It looks like it could be a good opportunity to do it that way. And who knows, as I was arguing earlier on in the stream, a lot of times when merger deals are made, they don't move up to the expected value of the merger based on the percent chance that the deal doesn't go through. Which I still think is a significant argument to make. The fact that the share for Discovery didn't move much on the announcement of the deal tells me that perhaps there's a significant chance that the deal doesn't go through. But I made that argument on the assumption that I thought that perhaps when we came to the end of this, that we would find that it actually was destructive to Discovery value, even if it was helpful to AT&T's value, and that perhaps it was a one-sided deal. But since it does look like it actually is a two-sided deal, I don't know, maybe shareholders are just not pricing in that expectation fully, and it's possible that if the deal doesn't go through, that they will be happier, but in my opinion they would be losing out on a significant opportunity. In fact, it's basically over doubling their return potential versus AT&T, like I said, only gained about 1% on net there. So as an AT&T shareholder, I look at this and it makes me almost tempted to pick up a couple shares of Discovery as well, just on the potential there. But I'm not necessarily going to rush into it, because 12.45 is not usually a percentage that's enough for me to rush in to make that deal on its own. But like I said, as an AT&T shareholder that has bought into AT&T much earlier than this, and so the expected return on AT&T is not really my only return on them. That's just what the current expected return is on them. I think owning AT&T at least until the end of Warner Brothers merger, assuming it does go through, would be a good way to go. And whether or not I decide to keep Discovery or AT&T or both after the fact, I will probably make that decision closer to that deal and afterwards and see what happens. But either way, this looks like a great deal. Who cares that the dividend's going to get slashed, because returns can be returned to you in multiple ways. I'm not a retiree that's dependent on income. So at the end of this, I'll just say, it looks good. I like the stock. We'll have to keep an eye on this. Like I said, if this dips lower, goes closer to 25 or something, and maybe this gets up to like 15-16%, maybe then that would even make it more appealing to possibly own both until the merger, as sort of like a hedging against either position. But part of me would be concerned to see what would happen to the value of this if the deal doesn't go through, because like I said, the company without the deal, in my opinion, is much less attractive. So I wouldn't necessarily want to take that risk. Well, it seems to me that AT&T, like I said, their value doesn't change too much depending on what happens with the deal or not. In fact, even though my expectations of value would go down for AT&T if they didn't take the deal, it seems that the market would be more appreciative of it, because they seem to want to keep the dividend. So if the deal doesn't go through with AT&T, I wouldn't be surprised to see AT&T go up. While if the deal does go through with Discovery, it may go up in the short run, but I would expect that to be actually bad for the value of it. So part of me doesn't really want to jump into own Discovery as well as AT&T. I kind of just want to hold AT&T and get those shares of Discovery, Warner Brothers Discovery when it comes through. But again, that might change if Discovery goes low enough in the short term before the deal goes through. But hopefully the deal goes through. That's all I got to say on that subject. So either way, that's going to be it for today. This has been Live Valuation on Midas Moriarty. We stream 3 times a week, Monday, Wednesday, Friday at 10:30 a.m. Eastern. Please subscribe to the channel if you enjoy content like this. And one more other slight warning, like I said, a lot of this includes a lot of assumptions about how this plays into value that I'm not 100% sure I understand. Like, for example, the change in the share count and the change in the debt to equity ratio is a little bit funky because, like I said, we're trying to estimate possible market values, and that makes it a little bit of a toss-up. So it could be all over the place a little bit with that. But overall, I think that since this came to a much more rational number in the end, I think that actually means that what I did here probably was close to right, because otherwise I think we would have been way all over the place. Like if we had ended up with some like $100 share price or something, then I would have really been questioning what I was doing. And same thing on the downside. If we had ended up with like $5 a share or something, then I would have been really questioning if I had done it right. But the fact that it's not so far off from the current value that you can say that this is just investors not appreciating the full value makes sense. It's like a moderate change in value would have made more sense to me than some dramatic change in value, because if it had been some dramatic change in value, I would have assumed that the stock would have tanked or it would have spiked up on the announcement. But like I said, it could also just be that the shareholders themselves don't expect the deal to go through. But either way, I would have expected a dramatic change in value if there was going to be a dramatic change in value. So the fact that it's only maybe about a 30% change, 35% change in value, that's a small enough difference that it could be that the market's just not appreciating what's here. And so I think that perhaps all the changes we made are actually possibly close to the truth, but who knows? Like I said, this is a different type of valuation than I've ever done before, and we included a lot of assumptions that I don't normally make. So either way, that is what it is. But again, this has been Live Valuation. Please join us again on Monday. Not sure what we're going to be doing, but whatever. I will put out my scheduled stream at some point, probably on Sunday night on that. But either way, catch you all next time.